Good morning, everyone. Clayton Miller here with Makeover. Talking about another FAQ, frequently asked question that we get, I don't know, this one we probably get weekly, and it is always from investors. There are several different types of folks that want to use the renovation loan, whether they want to buy their own personal home, whether they want to buy a multifamily, whether they like the creativity of it all, where they get to go do a renovation, or maybe they want to refinance their own house. I mean, there's a million different ways to get into the space, but one of them is investors who maybe are just getting started, don't have a ton of liquid capital, and don't have the ability to go buy a house that's, kind of on the rougher side, and then turn around and throw $50, $60, $70, $150,000 in cash at a renovation project. The other problem that they have is, from a commercial standpoint, they can't go get a commercial loan because maybe they don't have a proven track record, maybe they don't have a ton of money, could be a million reasons. So anyway, the 203k has become an investment vehicle, or a financial vehicle for those investors out there, because yes, you can in fact purchase an investment property using the 203k, and you can do that either owner occupied or owner non-occupied. Okay, so on the owner occupied side, maybe you're going to be buying a duplex or a threeplex or a fourplex. You can go up to 4. And your intention is you're going to be purchasing this home, doing a renovation on it, and then you're going to rent out the other 1 unit, 2 unit, or 3 units, but you have to live in one of them. That would be considered an owner occupied. In this instance, you get all the benefits that come with a lower credit score as an option. Having a smaller down payment, that 3.5% that the 203k warrants, or the 5% that the conventional warrants. Your debt to income doesn't have to be as strong. There's a number of different reasons why an owner occupied is going to be a little bit easier. It's just like using an FHA loan to buy a house, first time home buyer kind of game. So owner occupied, pretty easy entry point. Now, if you're looking at it from an owner non-occupied property, it is a little bit trickier. The program is built to help people find a home for them to live in, not necessarily for investors out there. The main difference is, and this is a relatively big one, if you're going to be purchasing a house non-owner occupied, the main difference is, rather than that nice small 3.5%, 5% down, you're going to be looking at something closer to 20 to 25% down. Now, in the grand scheme of things, this could still be a great decision for you. Putting 25% down on a $300,000 project, rather than buying the house for $100 and then shelling out another $150, you're $250 in it. 25% down is much, much better than that, $250 it would take to do that project. So the 203k could be a very good investment strategy or financial strategy for investors. However, 9 times out of 10, when I get a hold of them, they give me a call, hey, I'm looking to buy this thing, non-owner occupied investment, and I let them know, did you know, rather than 3.5%, you're going to be looking at 25%. That typically turns their heads away. So owner occupied, you get all the bells and whistles, all the nice low rates, all the nice low down payment. Non-owner occupied, you do have to pay a little bit more out of pocket. So that is your tip for the day. For all of you investors out there, call us over here at Makeover and we'll walk you right through it.